Today, we're going to dive into a couple who's 60 years old today. They're looking to retire in the next couple of years, and all of their assets are in their pre-tax retirement accounts. And so leading up to retirement, when they start thinking about things like income planning and more strategic retirement planning, they're in a spot where they just aren't sure what to do, and they want to make sure that they keep the most amount of their hard-earned money in their pocket. So let's dive into their situation. And before we do, if you want to create a plan just like this, just like the plan that we have here for Sam and Hannah, then I invite you to click the link in the description, create your free retirement plan, and you will be on your way in no time. So let's dive into it. For the sake of this example, these names are made up, but here we have Sam and Hannah. They're 60 years old. Going into their income today, they are still working. Sam's salary is $80,000 a year, and Hannah's salary is $65,000 a year. This is just more so for anything, for context for you around their plan. So we'll quickly go through this. They save, like we said, all of their assets, all of their money is in these pre-tax qualified retirement accounts. Going into their expenses, they have $6,000 per month in expenses pre-retirement. Going into their net worth here, we can see that their total portfolio balance is $816,000. That's spread across Sam's 401k and Hannah's 401k. Going into their goals, they'd like to retire in 2 years, spend $6,250 per month in retirement. We are going to use the annual retirement health cost here, just the estimate of $6,400. And that's just the national average here for both Sam and Hannah. It is important to note that we can add multiple goals, right? So if you're thinking about creating a plan just like this, we can go in here and add, long-term care goals. And specifically, what does that look like? In-home care versus, at a long-term care facility. What does that cost difference look like? Education goals. Car goals. Are you going to buy new vehicles in retirement? Vacation goals. Are you going to fund a wedding? Do you have a dependent or a kid that's getting married soon? Primary home relocation, investment property purchases, vacation home, etc. Gifts, various asset purchases. So this is really where your plan is going to start. What is it that you want to do in retirement, both short-term and long-term? But for Sam and Hannah, let's leave it like this. Let's dive into the retirement analysis. And what we can see immediately is they're actually in a pretty good spot. As of today, given all the inputs, they have an 80% probability of success with just over $2 million in median assets. And so when we think about what they have going on, what's really going to drive their probability of success here is how are they allocated? How much are they spending? When are they going to retire? So just so you can see this, what happens if they elect to work until the age of 64? Maybe they really like work. They're fine working the extra 2 years. What does this do to their plan? Well, now we can see they have a 94% probability of success with $3.3 million in ending assets. And see, as it relates to the probability of success, a couple things we want to be mindful of here is this isn't just, hey, flat out, you have a 94% probability of retiring and doing all these things. What this is saying is 94% of the time, things are going to work out relative to what we have here in the plan. And 6% of the time, we're going to have to make adjustments, whether that's to the spending, to our allocation, things like that. So looking at Sam and Hannah, we could go through and we could see, hey, what does it look like if we retire at 62, at 64, at 67? What does it look like if instead of collecting Social Security at the age of 67, full retirement age, we collect as early as possible at the age of 62? How does this impact our plan? And we can see here that this lowers our probability of success. What's interesting is it actually ups the amount of median ending assets. Why? Because there is no big income gap there. As soon as we retire, we're collecting our Social Security benefit. So before this video gets way too long, let's dive into what this video is about. All of your assets are in pre-tax accounts, like Sam and Hannah. What do you do? How do you start thinking about your income in retirement? Well, as we know, with those pre-tax accounts, all of our money went into those accounts pre-tax. Therefore, when we pull the money out, we are going to be taxed on that income that we're pulling out. So if we are relying on our portfolio for income in retirement, and for Sam and Hannah, we're just going to dive into the retirement details, and we'll go to the withdrawal rate. we can see here that we will be relying on our portfolio for the lion's share of retirement at, just under 5%. And so what that means is we need our portfolio in retirement for income. And so what we want to be mindful of is all of this income today is going to be taxed at ordinary income. Is there an opportunity in here for Sam and Hannah to maybe optimize this and increase the amount of tax-adjusted ending assets in their plan? So let's get into it. So let's go into our tax. We're going to go into our tax strategies, and then we're going to go into here and see what doing Roth conversions does for our plan. Roth conversions are simply taking assets from a pre-tax IRA and moving those assets into a Roth IRA. The catch here is on the year that you do this, you must record that as income, meaning you will pay taxes on that money that you're moving from a traditional IRA into that Roth IRA. Now, what if we convert or fill up the 12% tax bracket? As we can see here, this makes a big difference. We can see that this will result in $588,000 more in tax-adjusted ending assets. That is just total assets at the end of our plan. So relative to our Roth conversions, we can see here the exact conversion amount that if we were to engage in this plan of filling up the 12% tax bracket, saving about $588,000 more in tax-adjusted ending assets, then we will want to convert starting at the age of 62 in 2027 up until the age of 79 in 2044. And now do keep in mind, I'm not saying Roth conversions necessarily make sense for your situation. But for Sam and Hannah, given their asset location, their income, their desired retirement date, and their goals in retirement, we can see here that converting and filling up that 12% tax bracket makes sense for them. Now, what if they were to do the 22% tax bracket? How does this impact their plan? And what we can see here is, yes, they will still have way more in tax-adjusted ending assets, $542,000. But here's the catch. They actually have less than if they were to fill up that 12% tax bracket. So just on my same train of thought here, what if we were to fill up the 24% tax bracket? We can see here that they'll actually have $150,000 less. So guys, this is where proper planning for these Roth conversions is extremely important. We can see here that there is such thing as over converting. You might hear, oh, a Roth conversion could save me $580,000 in tax-adjusted ending assets. So I'm just going to convert for the sake of converting. Well, what if by mistake you fill up that 12% tax bracket, but then you leak into the 22% tax bracket? What will that do to your plan? And we can see, yeah, you'll still save or have a lot more in tax-adjusted ending assets, but you could have actually had more if you only filled up that 12% tax bracket. So guys, the point of this video is, how can you keep more of your hard-earned money in your pocket when you retire? Where is your income coming from? Is it coming from a pre-tax retirement account? Is it coming from a taxable account? Or is it coming from a Roth IRA, a tax-free account? When you think about your income plan in retirement, when you think about your retirement plan, your goals, and what you have going on, think about Roth conversions. Maybe they make sense for you, maybe they don't. But in this example, for Sam and Hannah, we can see here that doing Roth conversions up to that 12% tax bracket, up until the age of 80, so from retirement from 62 up until the age of 80, for them, this resulted in $588,000 more in tax-adjusted ending assets. This is advantageous for them and their plan. Guys, if you want more content just like this, I invite you to subscribe to the channel. And as always, I hope you enjoyed it. Thank you so much, and until next time, bye-bye.